Thank you, everyone. Good morning to everyone in the Americas. Good evening everywhere else in the world. My name is Francisco Vázquez. Today we have a great panel. We're going to have a great conversation. On behalf of CFA Mexico, I would like to thank Colchester Global Investors for sponsoring this event. I would personally like to thank Guillermina Pagasa, who is our executive director in CFA Mexico, for putting this together and for making this happen. And as I said, we have a great panel. I am really honored to be hosting it. We have Cian O'Brien from Colchester Global Investors. He's the head of investment management for Europe and the Americas, and he's also the chief executive officer based in Dublin. We have Juan Quintero from the World Bank. He's an engagement manager in the Reserve Advisory Management Program of the World Bank. We have Hermann Kamil from the head of sovereign debt management in the Uruguay Ministry of Economy and Finance. And we have Ignacio Saralegui, who is the head of portfolio solutions for Vanguard Latam. So really, we have a great panel to discuss today's topic, which is managing uncertainties for exchange rate and capital flows. There are many things happening in the world, and our four speakers will have a lot of interesting things to say. We encourage everyone to send your questions through the chat application, through the chat facility in Zoom. And with no further ado, and in order to leave as much time as possible to our speakers, let's start with Cian O'Brien from Colchester. Cian, please, the floor is yours.
Thank you. Thank you, Francisco. And good morning, good afternoon to everybody. Hopefully you can hear me okay. So as Francisco has said, I'm the head of investment management for Europe and the Americas at Colchester Global Investors. And when we think about global capital flows and the implications for exchange rates, obviously there are many potential issues we could talk about today, but the one that comes to mind for me is the US dollar, the outperformance of US capital markets and the US economy over the past decade or more. So what I'm going to do relatively briefly, in the interest of time, is just give a short presentation going through a couple of points that we at Colchester believe are quite pertinent today around what is a potentially very significant shift in capital flows, in sentiment towards the US, in what has been commonly known in recent years as US exceptionalism. So I'm going to share just a couple of slides to help me talk through this topic. So hopefully everybody can see this presentation. So the question is, are we looking at an end to what has been commonly referred to as US exceptionalism? We can define that in different ways, but let's say it is the outperformance of the US economy, the appreciation of the US dollar, the outperformance of US equities over recent years, which has obviously been both a function of and a driver of significant capital inflows to the US. Now, of course, there are a lot of good and valid reasons why the US has been the recipient of significant capital inflows. It has strong structural advantages in terms of its dynamism, levels of technological innovation, the depth and liquidity of its capital markets. But what we are potentially seeing today, for various reasons, is a shift in attitude towards the US economy, US assets, and potentially some reversal of this trend in capital flows. Now, there are probably two important drivers of that change. I would say briefly, there's clearly been a change in policy making and policy stability in the US, and that has led to some weakening of confidence amongst investors. But at the same time, there's also an increasing recognition, we believe, that US assets in general are starting from a point of significant overvaluation. And that's critical to the medium-term outlook here, not just for US assets, but for global asset allocation. And of course, what we're probably all very familiar with is what has happened over recent years in terms of capital flows, rising global imbalances. Of course, global imbalances have been discussed as a potential risk and source of vulnerability for many years. And they did stabilize, shall we say, in the 2008 to 2010 period. But thereafter, there has been a significant increase again in the level of global imbalances as measured here by the net international investment position, and basically the US on one side running large current account deficits, building up an increasingly large net international liability position relative to the rest of the world. And effectively what we believe is that this is a source of rising vulnerability. It's not necessarily an indicator or a prediction that there's going to be some kind of significant shift in capital flows into the US, but it certainly raises in our mind the probability of some kind of negative shock or reversal of capital flows leading to potentially significant negative outcomes. So the US, as you can see here, running significant fiscal and current account deficits. And I think it's worth, we would argue, just focusing a little bit on the fiscal balance in the US as a driver of the current account deficits that we're seeing in recent years. And there has been a notable shift in the relationship between the deficit and the level of unemployment in the past 8 to 9 years. So you can see on the chart that from around the 2016 period, arguably US fiscal policy has been running far too loose. And I think that's certainly the case in more recent years. The excess fiscal deficit is at least part of the driver, arguably, of the outperformance of the US economy in terms of growth to the so-called US exceptionalism. It's obviously a strong contributory factor to the large current account deficit and trade deficit that the US is running. And the large deficit is obviously translating into a rising level of government debt in the US. And that is increasingly a focus for us as bond investors. It's increasingly a source of concern for the market, as we've seen recently, not least with the downgrade announced by Moody's. The other element that concerns us somewhat is the exchange rate. So the US dollar, in our opinion, is at extremes of overvaluation in real terms. So obviously there has been some decline, certainly in the dollar in the past few months. But nonetheless, if we look at the long term, and this chart shows you our estimation of the dollar's over or undervaluation relative to a basket of developed market currencies. So where this number is negative, it's showing a basket of developed market currencies to be undervalued against the dollar, and conversely, the US dollar overvalued. So we're not too far away from the levels of real overvaluation in the dollar, which prevailed in the mid-1980s and ultimately led to the Plaza Accord in September '85. So in our opinion, at least, the current backdrop is characterized by rising concerns around fiscal policy in the US, rising concerns around the overvaluation of the US dollar, and I think there are clear potential downside implications there for asset values in the US and for global capital flows. Now, the flip side of that, of course, is that there are potential opportunities for US dollar-based investors to think more about global diversification. So I think one of the features of the past decade or more of such strong capital inflows to the US has been strong home bias in the US market and a strong preference amongst global investors to hold US liabilities effectively. But coming back to the point about valuations, where we are right now, in our opinion, presents quite an interesting opportunity to consider non-US investment opportunities. For example, the Japanese yen, extremely undervalued in real terms, very strong fundamentals in terms of that positive net international investment position, persistent current account surpluses, etc. And also on the fixed income side, a portfolio of global government bonds hedged into US dollars typically tends to produce a return slightly higher than the US Treasury market, but perhaps more importantly, with a lower volatility. So I think what's going to be interesting from here when we're talking about capital flows, exchange rates, interest rates, is the extent to which investors look to diversify more and potentially reduce exposure to the US for the reasons I mentioned at the beginning. So I've gone through quite a number of high-level, perhaps, topics there. In the interest of time, I'm going to stop. Look forward to hearing from the other panelists, and if anyone has any questions, also happy to answer them. Thank you.
Thank you. Thank you, Cian. Very insightful. Very insightful. Cian, can you mute your computer? Thanks. And very insightful, and we look forward to hearing from the public and hearing their comments. So, Hermann, from your perspective in the Ministry of Finance of Uruguay, how are you seeing your situation? Please, the floor is yours. Looking forward to hearing from you.
Thank you, Francisco, and also thank you for the invitation to the panel. So my short presentation is going to be based on the vantage point of a emerging market country with an investment grade that is thinking about its financing strategy and then management actions for this year and subsequent ones. And I'm going to piggyback on the very nice presentation by Cian to highlight some of our key cornerstones for their management strategy, which also takes into account some of the highlights I just mentioned. The first point I would make is that what we are seeing is in the dollar market, which is typically our reference point, particularly on the 10-year maturities, we saw a steep increase in treasury yields over the last few months, and the future path of the treasury yields is highly unpredictable, given that you have cross currents there. On the one hand, you have a decelerating economy and a decelerating inflation rate, which would call for lower yields going forward. But on the other hand, as Cian pointed out, there are significant concerns both in flows, the fiscal deficits, and in stock, the debt burden of the US, that could call or would require larger supplies of treasury bonds that would then put pressure on the treasury yield. So that's one important point of consideration for us. The second one is that there are more risk premiums being built into our secondary markets as a result of high volatility coming both policy-induced but also by geopolitical events. And those are two key considerations for the case of a country like Uruguay. I would add to that typically when an investor is assessing any portfolio allocation, the three key risks that are highlighted is credit, currency, and liquidity. I would say from the vantage point of a sovereign issuer, we have to add a fourth risk, which is execution risk, meaning every time we go to the market, we have to tap the market. The actual execution and syndication, even if it's done intraday, carries substantial risks, as market can move from 1 minute to another only on the back of a tweet. So more than a risk on, risk off, sometimes is tweet on, tweet off, and that creates a execution risk within our issuance windows that is also very important as an issuer to take into account. So within that context, then, just to share some of the cornerstones for our strategy going forward, the first one is to continue with funding diversification. And for that reason, we are increasing our reliance on domestic markets where we have a strong institutional investor base, which is more stable and less sensitive to global market conditions. But also, we are marketing more and more to crossover as well as ESG dedicated international buyers. So thinking in terms of funding diversification is also important, not only in terms of jurisdictions, but also on the nature of investors that would be willing to buy your bonds in primary markets. The second focus of us is on currency diversification. And I guess that's something that was highlighted by Cian. And that includes naturally local currency because we want to maximize penetration in certain target markets and avoid the over-reliance on dollar sources or dollar investors, so we don't have to put so much pressure on our MB spread. So in other words, what we are going to be looking going forward is to have a balanced currency composition of international debt issuances, both in terms of local and foreign currency issuance. And we do not rule out, and in fact, we are actively exploring the possibility of issuing in other currencies from advanced economies other than the dollar and other than the Japanese yen, for example, some European countries where that offers much lower interest rates, where cross-currency basis swaps can be working in the favor of the issuer, and where you may have already seen a steady increase in the value of those currencies, which in a way protects from further appreciation. Here I want to bring up a point Cian mentioned, that a very big shift that is in motion and is happening in markets. For decades, the dollar has been negatively correlated to risk. And this has been an important factor in hedging decisions for international and institutional investors, meaning they were more likely to leave their US dollar exposure open because that was a hedging property. But as Cian has just shown, I mean, that may be changing, and it's possible that it changes even more going forward. So we want to understand, talking to investors, what are the implications, not only for the demand from other advanced economies currencies, but what could be eventually the demand from local currency assets from emerging markets. So the third point that I want to highlight when it comes to our sovereign debt management strategy is the concept of pre-funding, as the Republic has been doing for a decade now. And what we see is that it provides us greater flexibility to select issuance windows, but also to bridge periods of heightened volatility, for example, associated to trade policy, associated to geopolitical event. The most expensive money is the one you cannot get during times of stress. So for us, it's also very important to have a pre-funding policy. And tied to that, whenever we think about funding, typically we think in terms of capital markets, but it's also very important for us to actively have a set of multilateral credit lines from multilateral organizations, where they could act as a fallback for any extraordinary or persistent market dislocation. I mean, typically, the insurance instruments look expensive until you use them. And we had the lesson from 2020 from the pandemia, where having credit lines available that we could disburse in less than 2 weeks actually was instrumental for us to bridge that period. And finally, I want to bring up a point where in Uruguay we've been working a lot with investors, but also with banks, is that the importance for an issuer like Uruguay to be promoting the functioning of secondary external bond markets. I mean, whenever we want to go to the market, the first reference on our cost of funding will be where our bonds are trading in Bloomberg screens in secondaries. So it's actually consequential to us that we encourage market making activities by banks and other financial intermediaries. We make sure that the prices that are shown in Bloomberg are transparent, that we foster the liquidity in all our dollar curves, because in the end, that would derive better funding conditions for Uruguay, but also a lower liquidity premium required by investors. So that's basically some of the ideas we wanted to share on the side of Uruguay. Thank you.
Thank you, Hermann.
Thank you, Herman. Very, very interesting, and without a doubt, the perspective of the issuer is clearly complementary to the perspective of the asset manager, like Colchester. So really, really insightful and complete. Let's now go to hear from Juan Carlos Quintero from the World Bank, who works in the Reserve Management Advisory. And as an advisory, maybe you can give us a third perspective on how to navigate the current environment. So, Juan Carlos, please, the floor is yours.
Thank you, Francisco. Can you hear me well?
Yes.
Okay. So it's a pleasure to be with all of you today, and I'm happy to support CFASociety of Mexico and CFA initiatives in general. So let me share a few slides that I think can. Give me a second.
I just enabled you to share. So
Okay. Let me see if it works. One sec. Can you see my slides?
It's coming up. It's coming up. Now you are on.
Okay.
Now you are on, but you may want to activate the presentation mode so that we can see the full screen. We can see the slide in the full screen.
Yeah, let me do it again. I think I'm sharing not the correct.
Yeah, you're sharing the other screen.
Mm-hmm. No.
It's not, but maybe you can leave that one and make it bigger. I don't know.
Let me try once again. Different sharing.
All right, you're on.
Oh, what are you seeing now?
It looks great now.
Yeah.
Now it looks great. Yeah.
Okay. So the perspective that I'm coming from is a bit different, as Francisco mentioned. I work at the World Bank Treasury in a partnership program that's called RAMP. And we're basically working with institutions to try to build the investment management capacity. So I'm not going to enter into the details, but we're not really looking at trying to predict the US dollar short, medium term. No, ours is much more a long-term perspective. And when we're looking into the different themes, including currencies, we're thinking this from this perspective. And it's a network, if you want. So part of what I'm going to be talking about is just what we've been talking with participants of RAMP. And as you can see on this slide, many of our institutions or the institutions that we work with are central banks. So the way that I'm thinking about currencies or a lot of what we do in terms of looking at currencies is from a central bank perspective. No, what is happening in the central banking community in terms of how do they understand the role of the US dollar and of other currencies. And that's kind of the way that I'm coming today, and that's what I wanted to share. So first picture, if you want, first idea, no, foreign reserves. You can see this is the last couple of years. There's a bit of variation, but overall, there's nothing huge happening. And you can see this slide has the components by currency. So the blue bar being the US dollar, we can talk about some shifts there, but overall the picture, not huge changes. The darker blue is the euro, not a huge not huge changes there either. Overall, you know, we're going to see that there's variation, but we're looking at the big picture, not huge changes in the components and of the foreign exchange of countries. We go a bit deeper into that, and this slide has, for the last 10 years or so, you can see what's happening with the US dollar. No, and this is something that people have been talking about. So is the US dollar decreasing? And you can see on the slide, this is only $10, so it is decreasing. It's still upwards to more than 50% of foreign reserves, but the tendency is going down, even though it's pretty slow. But 10 years, you're losing almost 10% on the graph. Euro continues to be almost flat, and all the others are kind of there's some increases, but there's not huge differences. So let's try to do a little bit of another zoom here. And in this slide, we have kind of those other currencies. So there's no euro here, there's no US dollar. And so what this slide shows, no, this is something that you've also seen in a couple of articles. The amount that the US dollar has decreased, it has been mostly gained by other currencies. It's a mix of different things. There's no big trend in one currency that is taking a charge. You can see on the slide, there's a bit of yen. There's a bit of some of these carry trade kind of currencies like the Canadian dollar, like the Aussie dollar. But there's really no big trend there's it's not a huge change in terms of where the dollar was maybe 10 years ago and where it is now, even though there's slightly chipping. The US dollar is dominance is chipping slowly. This is from it's kind of a similar message. This is coming from a survey that we do every 2 years. Central banks, once again, it's 130 something like that countries, and you can see it's kind of similar. On the upper right, you have the allocation by currency, very similar. The US dollar around 60%, and then you have the euro and all these other little currencies, including the renminbi. No, the renminbi is not very relevant still. And on the left, you have the exposition to the currency. So this is different. This is not how much they have, but how many of them allow the different currencies in their investment mandates. So you can see that almost everyone allows the US dollar. Euro is the second, and then you can see some of the recent changes. You know, if we look at this graph, some years ago, the renminbi didn't have 50% as a possibility. 50% of central banks did not allow for that investment. So there's a lot of countries trying to allow more investments into these alternative currencies, if you want, Aussie dollar, Canadian dollar, even though the exposure continues to be small, i.e. the US continues to be the dollar, the dominant currency. And of course, the other thing that when you look at central banks, you have to consider now is gold. No, and this is a graph of what's happening with the gold price. I think many people probably are here aware that we're on kind of highs. This is a very long-term graph. No, we're talking about 1920, and you can see that even adjusting for inflation, gold is near one of its highs, or it's in its highs for a very long time. So that's another relevant element. We see a slight diminution, a slight diminishment of the US dollar in foreign currencies, and this dollar price going up. And of course, this has an impact. This is a couple of graphs from a recent paper from the ECB that I think appeared this week, where you see a similar graph showing the composition of foreign reserves, but now including gold. And there was this highlight that, or this news that the gold was now bigger than the euro as a part of the composition of the foreign reserves, and it's mostly a price effect. There's a little bit of increment in the tons of gold, but it's mostly that the price of gold has increased so much that now the proportion is higher. As you can see, there's nothing definitely so interesting happening, or let me put it differently, it's not a huge change though in terms of the amount of gold that central banks have. And you can see that on the graph on the left. Now the green, it's not like the green portion of it has completely changed, but there's a bit of an increase because of both some purchases, and you can see it on the right, where you have the blue bars correspond to the purchases by central banks. The last 3 years have been consistently higher than usual. And there's, of course, this geopolitical element that that is part of the picture. Some specific countries are the ones that are buying most of this additional gold. And you have the price as well, not the price element that makes any component that you have in gold, any reserves, be value more if you want. So that's kind of where we are. And so what about going forward from this long-term perspective? And I think there's a lot of things, Cian, in his initial remarks, we're getting a lot of questions from our members in terms of what's happening. Is there any radical change now? And should we expect that some of the pictures that I just showed you, should we expect that they're going to be changing suddenly or quickly? And I think we look at the same data that other people do, so we understand there's a big issue with the deficit. No, there's this huge all that. I mean, I'm not going to go into that, but that's all relevant information. However, on the other hand, you also have, and I have a couple of examples here, but there's also a lot of additional info that you can bring in terms of some things have not changed. And I'm not saying that this is not going to, that there's no risks to this, but at least this still has not changed. And in this slide, there's one of the issues that I wanted to highlight. No, the US dollar continues to be the main currency in international transactions. And you can take a look at this. You can do your own research to look for this. That hasn't changed. And if that is the case, it's going to be difficult for for foreign exchange reserves to completely shift from where they are currently. Another example, where is that investment grade debt issued in what currency? No, most of the central banks are not going to be going into debt that has a lower rating. So this is relevant, and you can see this is very stable. And the US dollar continues to dominate the landscape. And so there's a few facts, if you want, in terms of what the reality is in terms of big amounts of money for these participants that has not changed. And I don't anticipate that's going to change suddenly. Doesn't mean that there's not a trend, and that the trend in the long term can continue chipping from the dollar in small amounts, but difficult to see that the reality has completely changed. And this seems to be the same. This is kind of my opinion on what we get from our members, but this is a different source. This is from a CFA actually published research, and they're asking, no, do you think that the US dollar is going to lose its reserve status? And you can see that the bigger parts of this pie, this 34 and this 51%, which is almost it's 86%. They're kind of saying maybe a little bit, but not really. And I think that's kind of the message that I'm also seeing from the data. Yeah, there's a tendency we're seeing that, but we don't see anything that's going to make this substantially higher, if you want. And I'll finish just by highlighting that we have this survey every 2 years, and we're going to have our next survey being published in the 3rd quarter of this year. And we hope to get some additional insights. That's all public information. And in our page, you can find the document when it's published. That's what I wanted to share. Thank you, Francisco.
No, thank you, Juan Carlos, and we look forward to reading the publication and to maybe have a follow-up with you once this is public, and discuss its findings and what you found out. So the great thing about this kind of events is the variety and diversity of perspectives according to mandates and positions. So Hermann from a government, you as an advisory to central banks, which have a very particular mandate, Cian obviously as an asset manager, and at the end of the day, everything is reflected in prices and how assets are moving. And I think there is no better person to talk about it than Ignacio Saralegui from Vanguard. So Ignacio, please, the floor is yours.
Thank you, Francisco, and just want to thank the CFA Society of Mexico for the event. It's a pleasure for me to share the session with all the other panelists. I'm going to focus as well from a investment perspective. How do we think about all these aspects of where we stand in the economy, and what does it actually mean to investment decisions? So please let me know once you see my screen. But before we go in, just want to mention every November, December, we launch our Vanguard Economic and Market Outlook. It has two main sections, our economic perspective, and then our market outlook, with the idea to help our clients in deciding, right, well, what does all this mean to building portfolios and actually managing the portfolios over the long term. So our views are also, even though we might have an economic perspective for the year, we tend to also think longer term, 5-10 years. We're strong believers that participating in the market is what really drives success for investors. And one of the main areas of control is maintaining discipline, right? How do you maintain discipline once you invest through all this market volatility? So that's where we tend to focus when we talk to advisors, retail clients, or even some of the organizations that support retirement goals in Mexico and different countries in Latin America. So for 2025, our economic outlook relies very heavily on the situation around tariffs. Two really cool charts here. On the left-hand side, we can see how the effective rate was moving along through history.
Ignacio, sorry, but
yep.
If you move to slide number 2, we are not seeing that. We are seeing just like with Juan Carlos before, we are seeing
okay,
like the PowerPoint. So yeah, now we can see it.
Yep.
Yeah.
How about now?
Yeah, now we still see like the whole PowerPoint interface. We are not seeing the full screen. Maybe you want to try to share a different screen, but we can see the charts. You know, it's really up to you if you want to give it a couple of extra shots, sharing a different screen or something.
Let me stop sharing. Sorry about that. Let me just.
It's okay.
All right, let's give it a try. How about now?
Now it works perfect.
Great. So what I'm referring is on the chart on the left-hand side, the effective tariff rate over history since 1900. And then you see the dotted line there, the idea of what Liberation Day actually meant. If you look at that chart, you can imply that in a couple of strokes, we went back to the 1900s as far as the globalization of the U.S. economy, and where do we settle? So that obviously is going to come down. We believe that effective rate is going to be somewhere around 12-13%. But then on the chart on the right, we think, all right, well, depending on where that effective rate, how is that going to impact GDP and inflation in the U.S.? Primarily, inflation, one of the key metrics that the Fed is making sure that they get hold of. They were hiking rates over the COVID years just to control inflation, and we see there in the red marked area. Nowadays, we have a perspective that inflation will settle in the U.S. around 3% or close to that 2% target that the Fed has. Implications for this is we don't think that the Fed is going to continue to cut rates below around 3.5% or 4%. And that implies also from an investment perspective that expectations for bond returns to be healthy, to be above inflation. So if you think about a real rate perspective, positive, we're coming of a period of 15 years since the 2008 financial crisis where real rates were negative. So we talk about sound money. So we are in an environment where now bonds actually provide growth in a multi-asset portfolio and not necessarily just create help diversification. We also think longer term. So we have this new research coming out that's called mega trends. And we think about how does the 6-7 megatrend factors would influence longer term the US economy, and that also influence the global economy. These factors are technology, demographics, fiscal deficit, globalization, and geopolitical risk. So how do we think about those, and how are those going to impact potential GDP and help also from a productivity standpoint? And how is that going to also help some of these high level of deficits that other panelists were mentioning from the US perspective in order to create that growth engine for the US economy? So we landed here where you're seeing two scenarios, which is they're on the right and on the left. Thinking about what we're thinking, status quo, economic, where we have anemic productivity growth, low inflation. For that case, we have a probability of around 10 to 20%, where GDP will be around 2%. This is the natural state of growth for the US economy. And then we are thinking that AI, artificial intelligence, would actually produce or transform the way that we work, and that would help productivity. We talk about AI sometimes that it's going to help us be more efficient. Transformational means that it's going to improve the way we work and the way we live in a similar way that electricity did, for example. You can think about a technology that created efficiency, but not necessarily was transformational, as probably the PC or the internet. So then we have these two cases where AI doesn't complete its full potential over the next 10 years, and we continue to have high deficits, and that would be a probability of around 40%, and that would create this environment where the economy in the US will grow around 1%. And then if AI is transformational and helps productivity, that will help us achieve levels of growth around 3% in the US. And right now we're positive. We have that as around 55% probability over the next 10 years. We see all these technology companies really putting a lot of capital into not only creating new technology, but also finding real economic application for the tools. So with this backdrop in mind, it's also going to help us think how might impact on asset flows or return potential, right? How do investors are going to start thinking about bonds, equity into their multi-asset portfolios? And the two charts we have here is on the left, we have 10-year return on the different periods. You'll see there the bars for on the left-hand side, the 10-year, the treasury yield. And then you see the two bars in colors, which represents these two cases where productivity surges based on the help and in the use of artificial intelligence in the economy. And we see that even though in that situations we think that rates, policy rates in the US will not continue to decline to zero. They will remain at around 3.5–4%. So some healthy return expectation from bonds. If the deficit dominates and AI is still out there but doesn't really create this transformational on productivity, we might see rates going all the way up to 6%, with the idea of potential expectation for bonds even more healthier, if that's the case. The chart on the right, it's the 10-year annualized U.S. equity returns in the green dark lines you see there, bars. And then you see the next 10 years, what are the return potentials. So if productivity surges, we might find ourselves in this 10% range expected return for U.S. equities. But if that doesn't happen, we might have to think about equity returns muted around 3%, even lower than bonds if you want to compare both of them. So given how these mega trends dynamic is going to work in the economy, it's also a good way to think about, well, what are the implications and how I will want to position my portfolio going forward. So with that, our model of expected returns, so this is the part of when we talk about capital markets outlook, we project expected returns for different asset classes. You see two tables here, the table on the top, it's the major fixed income sub-asset classes. If you look at the chart there, what we're showing is we don't necessarily talk about a certain level of an index, but we provide a medium return expectation with a range of outcomes. So with the probability around that expected return going forward. These are 10-year numbers in US dollars. And then you can see the volatility at the bottom, the median volatility, just to get a sense of, right, well, if I am expecting around 4.5% annualized return for US equities going forward, what kind of risk will that be? So you have there 6.5. The interesting thing here is if you look across the spectrum of fixed income, you see a return expectation of around 4 or 5%, depending on the different level of risk. And then a volatility of around 6, 7, maybe 12% if you start looking at emerging market debt. Now, thinking about where we see valuations nowadays for U.S. equities, U.S. valuations high from a cyclically adjusted price to earning perspective. We think that they still have room to growth, but not at the same level as the U.S. equity stock market has been providing returns. So if you look at U.S. equities, a medium expected returns of around 5.5 for a volatility of around 16%. If you go at the bottom table all the way to the right, you can compare that to markets outside of the U.S. And you see that the midpoint there in red, it's around 7%. So the expectation going forward is international equity markets to provide higher return than U.S. equities. Main drivers behind that is valuation expansion or contraction. We see a major valuation contraction from U.S. stocks, dividend growth, earnings growth, and there's some component of FX debilitation of the U.S. dollar over time. But the idea here is if you have remained heavily overweighted in U.S. equities, there might be a chance for you to also rebalance or think strategically how you're going to position in the different markets. To conclude, we grab all this information and say, well, how about if we put it in an example? So we picked the typical 60-40 portfolio that has been very much talked about, 60% equities, 40% bonds, and that's what you see on the top bar. This is a market cap portfolio. This might not be the portfolio for everyone, but that's just an example of how nowadays an investor can reduce risk in their portfolio and not sacrifice return potential given the level of interest rates expected for going forward. So we took that 60-40 and we told our optimization model, right, well, give us an optimized portfolio without sacrificing return. And the model provided this 38%, 42% portfolio. So actually kind of inverted. 38% equities, 42% bonds. And then within each of the asset classes, you can see some of the weights, key takeaways on the equity side, not so much overweight into US, but more of a 50-50 approach as far as US equities and domestic, not domestic, developed markets and emerging markets. And then within fixed income, really trying to take advantage of credit risk from the bond portfolio. And you can see the metrics there on the table. Both of these portfolios have an expected return based on our assumptions of around 6%. The expected volatility, it goes down for 6.8 to 9.2. That improves our expense ratio. That improves the expected Sharpe ratio from 0.34 to from 0.23 to 0.34, and also reduces some of that expected max drawdown. So just want to leave you with this. This is the idea behind our outlook, where we are in an environment where investors can reduce risk without sacrificing potential return going forward.
Thank you, Ignacio. This is, I mean, I'm hearing both from the side of issuers like Hermann and from our asset managers, a lot of interest on the euro, and it seems that, and also if you look at the comments from the audience, there is a lot of questions over there. So how, I don't know, I mean, like, do you see this more as a tactical medium-term condition? Do you expect normalcy to resume to the United States eventually? Or, I mean, because clearly the case for the euro is strong, but to what term? To what extent? To what, how long should we long the euro, I guess is the question, or how long should we trust in the euro? I know it's a tricky question, so we can pass to a different one.
Francisco, if I may,
Yeah.
only, indeed, from the point of view of Uruguay, we are interested in evaluating other European currencies, but not necessarily the euro. I mean, euro is one of them, but there may be others that could provide those diversification, currency diversification and investor-based diversification value that we are looking for.
Yeah.
Thank you.
No, thank you, Hermann.
Thank you.
Francisco,
No, thank you, Hermann.
just briefly from my side on the euro. So I think there are some indications that we're seeing some positive structural change in Europe. So fiscal policy, for example, if we consider that fiscal policy was a driver of US economic outperformance, we're seeing potentially significant fiscal loosening in the case of Germany, and that will have a spillover effect on the rest of the euro area. And I think at the margin, we're probably seeing some movement in the direction of further common debt issuance. So obviously there was the pandemic, which led to some increase in debt, common debt issuance. There's now the question of defense spending. Will that lead to another round of common debt issuance. So I think there are indications Europe is moving in the right direction, but I would actually agree with Juan Carlos in terms of the role of the dollar. I think it's not going to shift dramatically in the near term. Our view would really be more on the price or the exchange rate of the dollar. So its status can remain relatively stable whilst its price or its exchange rate can weaken.
Yeah. We have, let me check comments from the audience. Feel free to ask any questions. This event is supposed to last for an hour, but we can stay around for a while. So feel free to drop by. I have a question for all of you, and maybe we can close with that one. So if we all agree that the US is the long-term bet, and if we agree that the dollar is going to remain, and if we agree that the dollar is a strong currency, what is the role for EMs now? Do you see, in a medium-term perspective, do you see it as a return enhancer, as a diversifier? How do you, and obviously when you say EM, like there are so many EMs that the category is almost meaningless, but how do you see non-dollar assets right now? Do you see them as enhancers or diversifiers?
I can start with that. So from our perspective at Vanguard, our starting point is diversification, so market cap. So yeah, we tend to like to have exposure to emerging markets. And then if you think about the way how to implement that view, and in particular to have the currency in mind, when we talk about the equity markets, usually those investments include the local currency. When we project these capital markets expectations, we take into consideration the long projected structural appreciation or depreciation of each of their currencies. However, we don't think that the currency effect over the long term really impacts the risk return profile of the asset class in equity markets. So it's included in our projections. We tend to leave it there unhedged, so investors then take advantage also of any currency dislocations in the short term. Now, the story is different for bond markets. We do think that currency effect in international bonds actually distorts the risk return profile of the asset class. So in those cases, our international fixed income funds are usually hedged back to a strong currency, usually the dollar or the euro.
Okay. So no, thank you, Ignacio. We are at the hour, and I don't know if anybody else has any other comments or questions. If not, then we can close the meeting. I would really
Francisco?
like, yes.
Manuel Zapata is asking, any thoughts on the Mexican peso?
Any thoughts on the Mexican peso? I guess enjoy the ride while it lasts. That would be my thought. I don't know if anybody else would like to jump in, but enjoy it while it lasts, depending on which side of the trade you're in. So
I guess just a quick comment from my side. Yes. So as I mentioned, we do believe the US dollar is still meaningfully overvalued, which I think creates an opportunity for investors to look at local EM debt. So we're not equity specialists. We're only focused on fixed income, but I think within fixed income, there is a diversification argument for EM debt. And there is also a cyclical story for local currency debt now, given the overvaluation of the dollar. And I think the Mexican peso, as an example, can continue to benefit from that backdrop. If you do have a weakening dollar, I think you will see flows into local EM, and the peso can continue to benefit from that in the absence of any significant shocks.
Yeah.
Thank you. I don't know if there is a chance to make another. I have from Rafael Cepeda. We saw that currently and in the past, the reserve currency has been the dollar, but as historic shows, the reserve currency has lasted forever. And with the slowdown of the US economy, could we be at a point where the reserve currency is not longer the dollar?
I believe Juan Carlos, who left, would have been the most appropriate person to answer that question. But Cian, maybe you make Cian and Ignacio, maybe you want to add something over there. Cian and Ignacio,
Sure. Just a very quick one. I think nothing lasts forever. So clearly at some point things will probably change, but right now there's no currency or no country's capital markets offer you sufficient depth and liquidity to replace the dollar. So I think its reserve currency status is probably pretty safe for the foreseeable future.
Yeah, no, I tend to agree with that. Okay. So I think I don't see any other question, Guille. Do you have any other one under the radar?
No, it's okay.
Okay, well, Cian, Ignacio, Hermann, did you have fun today? Would you come back if we invite you again?
Absolutely.
Excellent. Okay, well, so thank you to all of you. Thank you to all the audience for participating. Thank you again, Guille, for organizing this event, and have a great day, everyone, and be aware of more events by CFA Mexico.
Thank
Thank you, Francisco.
Thank you, Francisco. Bye-bye.
Bye, everyone.